Hi, listeners. Welcome to It's the People, an interview series where we explore the inside story of building companies and investment portfolios, speaking with high-octane founders, limited partners, and fund managers. We hope these conversations push you to be even better at what you do. In this episode, my partner Wills Hapworth and I, Andy Greenfield, had the opportunity to interview Doug Carlson, who has advised the most sophisticated capital allocators in the world during a 25-year career at Cambridge Associates. In this interview, Doug discusses the importance of being obsessed with what you work on, staying the course in both bull and bear markets, how success can actually be destabilizing, and migrating from success to significance, and much more. To start off with, Doug begins the conversation with his life story in 60 seconds.
Before we begin, we'd like to note that this interview is for informational purposes only, and that the opinions expressed should not be relied upon as a basis for investment decisions. TIA Ventures is a seed-stage fund focusing primarily on early-stage business-to-business technology companies with an obsessive focus on end customers and early teams.
To the best you can you paint a picture of your life story in 60 seconds?
All right, I'll give that a shot. I'm originally from the East Coast, and after graduating from Colgate, not knowing what else to do, I went into banking in Manhattan, did that for 5 years, and then went to the Stanford Business School, where I got a more in-depth orientation into financial economics, which led to a corporate planning, strategic consulting position with Maricon Associates. And that was followed by several positions in treasury functions at Syntex, and then later as treasurer of Oracle Corporation, from which I went to Cambridge Associates in 1991. I spent 25 years at Cambridge and retired in 2016. At Cambridge, I advised several dozen very large endowed nonprofit institutions on the investment of their endowment, and as well as some large family groups. And through that experience, gained a pretty good orientation into private equity. Virtually every client that Cambridge advises is invested in, to some extent, in private equity, up and down the food chain from early stage to very late stage, and so that's where I got my orientation to private equity, and found that to be probably the most powerful growth engine of the portfolios that I worked on.
Hey, Doug, I'm curious, these days, a long career or a long stay at a company is 2 years. And you had a couple of those, 2-year stints, and then ended up at Cambridge for a quarter of a century. What motivated the move, and what got you to stay there for, the bulk of your professional career?
Well, I felt like a kid in a candy shop at Cambridge Associates. First of all, I worked in the West Coast, far away from the headquarters in Boston. And I was charged with getting the West Coast office off the ground. So there was an entrepreneurial kind of a building aspect to it, as well as advising clients, which I found very fulfilling. The other thing is that Cambridge kind of stands alone in the investment advisory world, in that they're completely free of all conflicts of interest or potential conflicts of interest. So there was a sleep well quality to it as well. And then finally, it's just the nature of the work. The outsourced CIO mode of working with a client really puts you in control of the portfolio. You are driving the portfolio, even though the client has the final say, and that is an extremely fulfilling position to be in, because the results you can take a lot of credit for. And these are America's greatest treasures, these large charitable foundations, the universities, the colleges, museums, performing arts groups, anything with an endowment, is good for our culture.
And given the span of a career like this, we'd love to hear you talk a little bit about some of the key themes you've seen over this career, over your career, about what makes the best investors.
In terms of the decision maker on who to hire, or in terms of the actual investor, as in the money manager?
Yes.
Okay. And the best investors, the best money managers, whether they are in the marketable securities realm or in the private equity realm, I think share some commonalities. The first one, and I think the most important one, is to be obsessive about what they do. And to be obsessive, they need to love it. And if they love it and are obsessive, they're probably going to be good at it, because they'll be thinking about it, day and night. And it's almost like anything else, whether you're a musician or a grave digger or whatever, you've got to be deeply into it viscerally to do well at it. So I look for that. The other thing I look for is a track record, of course. It has limitations in terms of its signaling as to whether the investor is good or not. And we all know those limitations. But if it's a successful track record and a legitimate one over a period of time, it does signal that there is probably some skill involved. And then finally, it's stability. It's stability of the organization and stability of the process. If you can keep people a long time and have a fluid, well-functioning organization, and if the process is well understood by the organization and consistently applied to selecting entrepreneurs to fund or selecting securities to buy, chances are the successful investment results of the past can be replicated.
Doug, your comment about, and really appreciate kind of you framing in very clear terms, who are the, call it like the best investors over time. I'm sure there's a lot more to it. Your comment about obsessiveness, I know, is something that we think a lot about. Oftentimes we come across companies that look like great market opportunities. There's a need, and there's that kind of intangible that takes us some time to figure out, which is the founder doesn't seem totally consumed with this. Rather, they just like the opportunity that kind of the market may be presenting to them, versus others. And I think of a few in our portfolio where I personally don't really care a whole lot. I don't mean that in a bad way, about what some of our companies are doing. And yet the founders are absolutely obsessed with ensuring that this thing becomes a reality. Have you found over time that there's a good way to kind of stress test managers' obsession with what they're doing? Or is it more of kind of an instinct that you've developed over time?
I think it's an instinct that you develop over time through interaction with the managers. There's no substitute for meeting with the managers a lot and getting to know them, hanging around their office, getting to know the entire team. Only through that sort of old-fashioned rubbing of elbows and getting to know them at a secondary and third level can you really get a sense for their obsessiveness. Very early on in my career, I got to know Phil Fisher a little bit, who was one of the legendary stock pickers. And he had a portfolio of 4 stocks in his that he put together for his clients. and he called the CEOs pretty much every day on a rotary phone. And he was about 90 years old when I got to know him. This is all he wanted to do. But he knew these companies and he knew their managements upside and down to such an extent that he had that instinct for when it was right to add to the portfolio, add to that holding, or trim the holding.
Yeah, Doug, over your career, I'm guessing you've interviewed thousands of funds and managers. And we always hear over and over again the importance of differentiation, or something standing out as, wow, I've not heard that. That actually sounds both relevant and differentiated. Without naming names, can you give us a sense of, an example of a fund or funds that stood out for truly being differentiated, and what made them different?
Well, I would say TIA Ventures is one that stands out and is being pretty differentiated. So I feel free to name that one. But in terms of others, most of the time it had to do with the backgrounds of the general partners who came out of various operating positions, usually if they're early stage in one industry. It could be life sciences, and I'm thinking about a firm in life sciences where they came out of several different places in life sciences, working on different aspects of it, and applied that deep knowledge to creating a portfolio of holdings that they found through their contacts and their actual work in the life sciences. So I think it was that background that enabled them to really focus and go deep into an area that gave them a special degree of expertise for investment decisions.
And just kind of springboarding off of that, you talk about the importance of rubbing elbows, and I'm guessing you've also seen thousands of pitches. Are there any things that particularly stand out over your career that have gotten you to lean forward in a pitch, whether it was the way it was done, who was giving it, anything that, when it comes to the pitch itself, which is kind of the sharp point of your contact, certainly your initial contact with a fund, anything that stands out?
To be delivered by the most senior people. It has to be the CEO and maybe one or two other people. Second, it has to be heavy on content and depth and light on gloss. So the pitch, the pitch has to be a serious pitch that is really content rich. Delivery doesn't matter. It's what's in there. Other than those sort of format issues, what is important is what I mentioned before, that what comes through in the pitch is an obsessiveness and a love for the business that makes you immediately want to get behind this team. You can relate to them as lovers of what they do and deep students of what they do.
And Doug, I can only imagine all the work that went into the diligence that you did on behalf of your clients. And, the last thing you want to do is pick somebody who, call it a fund later, you decide you don't want to continue to work with. And yet you also need to find new managers at times who don't necessarily have the track record. You don't really have a clear sense of what this will become. But you mentioned out of the gate the kind of stability of the organization and the process. Anything that you observed around newer managers that gave you an indication of this is a firm that, I don't know, plans to be around for a long time, and I believe that that's likely going to happen versus, others where they might have also been a new manager, but didn't seem like they didn't look like they checked the box from that kind of stability and process, check mark that you were looking for.
Well, that's a great question, and it's a very, very difficult one to answer. I think that's in terms of discernment for a new fund, especially an early fund. That's probably the most difficult thing to figure out, because if the team is together only a short while, you certainly don't have a lot of history at that firm. So what you would look for is their longevity, perhaps at earlier firms, and the story for why they're no longer at those earlier firms and have chosen to come together. So that you would want to probe that area and see if what they tell you kind of hangs together. Venture funds do dissolve once in a while, and very good people with long histories reemerge in different areas. I think of Benchmark, for instance, in the mid to late 1990s, when they spun out of I think it was TBI, and it's one half went to create Benchmark, the other half headed by, I think it was John Marquardt, created a different firm, and we dug in and we looked at their backgrounds, not only in terms of how long were they at their predecessor firm, but how well did they do at their predecessor firm. So you want to look for that. If they're coming out of an operating role and have decided to become venture capitalists, which is a very good thing, by the way, very good background for venture capital. You just, all I can say is you want to ask a lot of probing questions as to why they become venture capitalists, to see if it hangs together. It's really a visceral sense that you're looking for.
When you look at the strategy itself, putting aside for a second the people, is there anything that you look for in particular relative to the strategy, the fund strategy?
Well, yes, the fund strategy has to be, particularly if it's early stage, it has to be narrow enough to be implementable, because an early stage fund typically is a very small fund, and a small fund doesn't have the bandwidth or the personnel resources to do much more than one or two areas very well. If they're too scattered and diffuse in terms of their industry focus, I think that's a red flag. So looking for expertise, you want to find focus, and so you want to look for just one or two areas that they're into, and I think that's an area where red flags can arise quite a bit. If they come to you and say, well, we just want to find the best companies wherever they are, you just have to wonder, are they sitting back and waiting for things to cross their desk, or do they have a process? Do they have a focus? And do they have a philosophy for how to approach that niche that they're into?
Mm-hmm. Doug, you used a term that caught my attention here about red flags. And Andy and I have been doing this now for some time. And when we're talking to an entrepreneur, there are immediate red flags that go up when certain things are said. I'm curious, in addition to kind of like an earlier stage manager saying, hey, we're going to do it all, are were there other things across your career that started to become immediate red flags when you heard them or saw them?
Well, yeah. When I first started doing this, it was in the early 1990s, and venture capital was just exploding. As you recall, in the 1990s and then in the first decade of the century, the number of venture capital funds increased by about 100-fold out there. So there were a lot of ill-prepared, opportunistic young Turks jumping into the private equity world who thought they knew something about business because they went to the Harvard Business School, but they really didn't. And they were in it basically for the glamour and the money. They would never admit it, but basically they were trying it out to see if they could do well at it. Everything I've just said also applies to hedge funds, and that really gets to what we were talking about a moment ago about how do you weed out the opportunists there from the people who are in it for the right reasons and are going to have legs over the next 2 decades. So and it's how you separate the wheat from the chaff on that dimension is it's a gut feel. I mean, I really the best in venture capital investors have to start at some point. And at some point, they're going to look like young Turks like everybody else who don't have any background, don't know what they're doing. So you need to figure out some way to separate them. And I think the best answer I can give you is to just probe their love of the business, their obsessiveness, and hopefully that they have some operating background as well as the best in academics.
So, hey, Doug, I'm curious, just continuing on the red flag topic. Let's assume for a second that we've gotten past the young Turk factor and you have a bunch of old Turks coming through the door pitching you. Are there things that, as Wills was alluding to in our business, if we hear, sometimes we see an undue focus on dilution. The folks who want to own 95% of the car that doesn't have enough fuel to get out of the driveway. Or there are other things or signals to us, ego, we worry about. Are there things in your business that you've seen as somebody sitting and pitching that's immediately says to you, based on pattern recognition, I'm not going to invest with these guys?
I would say emphatically that you should be heavily, if they're in their 40s, 50s, or 60s, emphatically, you should be looking for operating experience. Track record and all that in venture is a good thing if you can identify it and measure it accurately. But operating experience, I think, is the number one criterion I would focus on if they're new to the private equity world, and then hopefully somebody in the organization also has some investing expertise to help them with those facets of investing that an operator would not have. A good backroom person or somebody who at least has some experience in backing entrepreneurs.
Doug, can you talk about why you've mentioned operating experience a number of times? Typically we think of, in the public markets, I don't think people think too much about, do the managers have operating experience? I could be wrong there, but that's my impression. Why is operating experience more relevant in your view at this sector of the market?
Because In venture capital, you are much closer to the operators than you are in the public markets. You're basically almost on their side of the table. And I'm talking about early stage venture. Later stage venture, you're not so much on their side of the table. But early stage, you're a mentor to the people that you're backing. And to be an effective mentor, you have to understand the different facets of running a business. So you need to know something about marketing. You need to know something about scaling and HR and production and everything, and strategy and everything else. And you just don't get that unless you've actually done it. So I think to be a good mentor to an early stage investment opportunity, you need to have had some background.
Got it.
Yeah.
And then on the last piece here, you've talked a bit about track record. I think we've heard a similar theme, like it needs to be there, but it's not necessarily a kind of forward-looking metric or indicator of the success of a firm. What's the apart from, hey, the track record is great, are there any things that you look for in particular in an early track record of a newer manager that is as important as kind of, I don't know, the results or maybe the on paper markups that they may have in their early investments?
Well, that's a very complicated question, and I could go on for hours about it. But the raw IRR, or rate of return, for a venture capital fund is a gross oversimplification of many other factors. The key question is, if it's a good number, is it replicable? And so it's a question of probabilities and odds. And what increases the probability of it being replicable is a more detailed look at where the number came from. Did it come from one home run in the portfolio that they've had in the past, or was it more from singles and doubles that they've had in the portfolio? Clearly, you want to have some home runs in there, but if you don't have some singles and doubles, but instead have a lot of failures in the portfolio, that is certainly a red flag, because singles and doubles are an indicator of replicability and a successful process, whereas home runs can be more serendipitous. And so you want to look for a sustained period of success. You want it to be across lots of different, a higher percentage of the holdings in the portfolio as an indicator of replicability. And ideally over several funds, several earlier funds. Beyond that, you need realizations. You need cash events in there to justify the numbers. Markups alone are not nearly as convincing as actual exits from the portfolio and returns of capital. So I think those are the key things.
And so if a fund, and I know we talk a lot about kind of earlier, newer managers, just because kind of that I think we're selfishly trying to learn as much as we can here. If a fund is successful and kind of finds a new partner, perhaps a client that Cambridge might represent, in very kind of simple terms, because I know you could get deep into this, you've passed all the red flags. What does it mean for a manager after that to like fundamentally mess things up or screw up? Like at all costs, what must a manager avoid doing, with a new limited partner, in your view? Because I'm sure, performance needs to be good and reporting needs to be good, but were there any things that you observed over your career that was like, hey, never do this?
Well, fortunately, haven't had very many experiences like that, partly because of the vetting that we did at Cambridge. But I would say that the most egregious thing that comes to mind is the communications with the fund. The fund has to be, reasonable in terms of the data that they present each quarter and each year, and they need to be accessible people. If their phone rings, they need to answer it, and they need to be forthright in answering questions, even probing questions about portfolio companies. They need to remember that the word partner in limited partner, that there's not an adversarial relationship. It is a partnership with you. And don't be afraid to be extremely candid with the limited partner. I think that builds credibility with them. And it really increases the odds that they'll re-up for the next fund. Or if you're doing co-investing, it increases the odds that they'll participate in the co-investments that you might offer them.
There's this big umbrella called private equity. And under that, there are things that range from, pre-seed up through Series E, D, EFG, et cetera. Well, what are the key differences you've seen as you look across the spectrum of private equity between early and late?
Oh, it's like day and night. The spectrum used to be, if you go all the way back to the 60s and 70s, the spectrum was much narrower. It was really just seed stage. I mean, the venture capitalists were practically living with the entrepreneurs, and they were all in it together, working hard, very, very hands-on, very, very high touch, a lot of mentoring and sharing of technologies. Today, seed stage is still that way, but then once you get up into later stages and even the growth stage, what they really become are, in the very late stage, they're window dressers for an exit. They're superbly good at recruiting new teams to prepare them for the public market. They have deep connections with the headhunters. They have deep connections with the investment banking community, and they have ways of preparing for an IPO or preparing for a strategic exit that early stage funds don't, and that's really what their value added is. So if they're coming in at stage Z to prepare for an exit, they have to have skills like that.
Is there any page out of the kind of later stage private equity playbook that you think earlier stage funds should be reading or paying attention to that they don't?
You mean in terms of how they evaluate earlier stage funds to get involved with?
I guess it could be how they evaluate, or maybe how they kind of operate. Obviously they don't have the resources. They might not have the AUM, but are there things that you observed over your career about like how later stage operators operate or kind of like run their business that you think newer managers or earlier stage managers maybe overlook or don't consider that would help them if they kind of just stole that best practice?
Well, if I understand the question right, you're asking. I'm sorry.
Maybe asked a different way. Hey, I interviewed thousands of later stage funds, and I also interviewed plenty of earlier stage funds, and I wish if there was one thing I could change about what the earlier stage funds do that looked more like what later stage funds do, it would be this?
I don't think there's a lot of that thinking going on because I see the two stages as being so fundamentally different that the wishes for one don't really translate into wishes for another. The skill sets need to be quite different. The focus of what they do is really quite different. Maybe the one thing that comes to mind to answer that question would be, the later stage funds are pretty ruthless in terms of making sure that the CEO and the other key people are sort of ready for the big event. Whereas I sense, but I'm not sure, that earlier stage funds are a little more reluctant to change out management, even if they perceive that maybe management should be changed out, because it's a much more intimate relationship at the early stage. You're deeper connections and maybe more of a sense of loyalty to management.
Mm-hmm. So shifting gears, Doug, you've been around long enough to have seen market cycles, and it feels like we're either in one or entering one right now, a shift. We certainly hear lots of, every venture capital blog is talking about that. What is important to know? Again, looking through the eyes of a guy who's seen a lot of this, about how capital allocators think and behave in these kinds of periods.
Yeah. Well, you put your finger on the issue. It's capital allocation. The problem is the most of the institutional investors and I would say also the large family offices have a specific percentage allocation set out for private equity, and it's codified in their plan. And what happens is you get this denominator effect when the public markets are in a funk, as they are right now, and they're down, say, 15 to 20%. The allocation denominator shrinks because the entire capital base has declined in value. Because venture capital doesn't go down in parallel with the public markets, it generally stays high, and therefore its percentage allocation in the overall portfolio jumps up. When it jumps up, there's a reluctance to make additional commitments to private equity and venture capital because you're already exceeding your targets, and so that's a long-winded way of saying when the capital markets, when the equity markets are down, that new venture capital commitments can be depressed at the same time.
Interesting. I get. Oh, sorry. Go for it. Continue.
Yeah, and just one further thought there is that that's very often a tough pill for portfolio managers to swallow. That is, the people in charge of the total fund, because intuitively they know that very often venture capital can get better prices when the capital markets are down. So it could be a good time to invest, even though they're already above their targets. It's a good time to invest, also, early stage venture capital is the closest thing to true innovation out there, besides being an operator. Innovation doesn't stop when the capital markets are in a funk. When you're in a bear market, innovation keeps going. And And so there are going to be opportunities to invest in early stage, regardless of what the capital markets, the broader capital markets are doing. And you don't want to miss those opportunities that are going to come along during a bear market from the entrepreneurs and the innovators out there.
Anything, else that assuming just kind of reading the tea leaves right now of what's going on, that you would advise managers to do, or maybe what you saw the best managers do over your career during kind of periods where capital was not as available, or there were kind of doubts about kind of, growth opportunities for businesses, just, like observations around what the best managers did during those periods when it was hard to sail the ship through the stormy kind of ocean.
When it's hard putting money to work or raising money?
Well, less so raising, assuming that you have a fund right now that you're deploying.
Well, raising capital when we're in the midst of a bear market is going to be tough for all but the most oversubscribed private equity funds out there. We all know that the Sequoias of the world can raise as much money as they want to raise at any time. But for everybody else, I think what you just have to do is remind investors that entrepreneurial activity and innovation does not cease during bear markets, and some of the best opportunities can come along with less competition for funding them from other venture funds when the markets are down. And so it can be actually, paradoxically, it could be an opportune time to keep investing. From the standpoint of putting money to work, I think it's a great time to put money to work because it relieves price pressure and maybe competitive pressure, particularly in the later rounds when you would see some competition from other funds, and you want to take advantage of that. So there's a little bit of buy low, sell high mindset in the venture world that everybody should keep in mind.
It's really, really interesting. Another question, again, asked to a guy who's looked at everything from, as you mentioned, Sequoia to probably no-name funds. How significant, how important is that brand name when it comes to picking managers?
Well, I think the brand names are almost by definition going to be later stage funds. Mm-hmm. And it beyond the top tier of Sequoia, Kleiner, Benchmark, and Andreessen Horowitz, and so on. Once you get past that top tier, it's very important because the top tier has a truly unfair competitive advantage because of the unspoken pecking order that exists in the later stage, where if you're a successful entrepreneur and your company is doing great, and you want to engage with a later stage fund, you want to go with the later stage fund that has had the best success and is the most respected and really knows how to create an exit event for you better than the others. Everybody knows through experience that the top tier is better at it, and that's how they got to be top tier. So unless there's something internally going on to upset those companies in the top tier, you would naturally want to go with them.
Got it. If we shift gears a little bit towards Doug, the investor, And as a guy who's, again, been doing this for a long, long time, how does your experience inform your own personal investing philosophy? Does this do as I say, not as I do, or something different?
In my experience at Cambridge Associates.
Well, you're a guy who's as I said to Wills, if I had listened to you throughout my life when it came to investing, I would be considerably better off today than I am. So I'm curious when it comes to your own investing, what have you sort of taken from Cambridge? How closely do you follow those precepts, or, for example, I'm more conservative with my clients' money than I am with my own. Can you talk a little bit about the way you look at your own investing?
Well, I look at my own investing in a delightfully unshackled way. I don't need to be thinking about the optics of what I'm doing for any particular client. I can do what I absolutely think is in my purest economic interest, and what that means is that I can follow my gut a little bit more in terms of who I choose to invest with, rather than necessarily following the recommendations of the internal research group at Cambridge. You may not know it, but Cambridge has a very deep private equity research group, and I basically was unable to deviate from their recommendations. It was a little bit of a CYA corporate governance issue there. And so that was somewhat constraining. Furthermore, Cambridge could not invest in the earliest stage seed-like venture funds because one Cambridge client could completely consume the capacity of that fund. So they couldn't dedicate a lot of due diligence resources to the smaller funds. And that's unfortunate because the highest return potential is really from the smaller, earlier stage funds.
Doug, I'm not sure it's a totally perfect comparison, but based on Andy's question, it seemed as though there was kind of like a difference between how you do this personally versus how you did it professionally. And I'm curious, do you think there's a difference between being a good investor and being a good fund manager? Yeah.
When you say fund manager, are you referring to the CIO?
No, more like, partners, general partners in a fund who decide that they're going to be in the fund business, which is also the investing business. But yeah, we're now in the fund business, and you start to learn that, there's things that you didn't really expect to be having to do in the fund business. You thought it was just about investing. And I guess I'm just trying to understand if you think there's some differences about who are great investors versus, or maybe or who might also be great fund managers. And I think really, is there a difference between being a good investor and being a good fund manager who might want to build out a franchise of funds? Or do you maybe you just see them as one and the same?
Well, to answer your question, Wells, I think some of the great investors are angel investors who have deep operating experience and know some of the entrepreneurs out there. And you see this all over Silicon Valley. These are people who choose to be their own selector of investment opportunities, and they have a good network of people to choose from. They know something about the businesses they're investing in because of their operating backgrounds, and they're, it's a very liberating way to invest because they're really unshackled from the fund structure. But I don't think a well functioning seed stage fund is that much different. They just happen to have limiteds, and they happen to have a little more corporate structure around them, but not a lot.
Mm-hmm. And then, as those funds start to grow, what are some of the kind of conflicts of interest or maybe even perverse incentives that you started to see emerge as a fund grew, and how did the best ones manage those?
I think the real challenge as funds grow, the biggest challenge is to keep their people. The very nature and longevity of the funds, being 10 years or 12 years, tends to keep them, but it's not perfect, and people do leave, particularly if they're right below the partner level, and they lose some very good people. And these people are, the rising general partners. So they're the future of the firm, but they also fulfill an important role in doing research for those firms. So keeping them is really, really important. A stable organization is the biggest thing. I think another issue, which is somewhat destabilizing, is success itself. The funds can be so unbelievably enriching for the individuals that there can be erosion of incentives, and in particular, as they get larger, the management fees are so big relative to the carry that the emphasis on success and carry is diminished somewhat.
Just springboarding off of that, how do you either force or create alignment then when you're in situations where you're deploying, large chunks of client capital into funds where the managers do incredibly well regardless of how the client does, at least in a given fund?
Yeah. There is no way to force that. You can complain about it at the inception of the fund, push back a little bit on the fund compensation structure, and the big research universities, the highly desirable limiteds, had the power to do that once upon a time. So they would push back. Harvard and Stanford would push back. Yale would push back, and they would get modifications to terms. But that really doesn't happen anymore. It's a take it or leave it proposition from the venture capital fund. And if you don't like it, the only thing you can do is just not invest.
Doug, was there any species of advice that you found was the hardest for your clients to follow?
The only with respect to private equity, I guess two things would have been challenging from time to time. One is keeping a steady pace of investing over time, even if they hit a rough patch. To stay in the markets, continue to make commitments, even if the markets seem to be down. And certainly during the 08, 09 period, and before that, during the tech wreck, that was a challenge. Another was occasionally there would be some skepticism about the J curve effect. They'd see that a fund isn't producing anything close to positive early on, and so unless you really understand the mathematics behind that, and you have faith in the future, that can be bothersome to some of the more naive clients.
Doug, you're probably one of the calmest guys I know. I was saying to Wills, I can't remember ever seeing you get angry, yell, scream, but you're operating in one of the highest stakes environments where literally hundreds of millions of dollars, sometimes billions, are on the table. How did you deal with the pressure? Did I just not see you go crazy or start shaking with either anger, fear, anxiety, or was it just your nature?
Well, first of all, by that, you think of me as sort of like a duck, very calm on top of the water, but if you look right below the surface, the feet are, the paddles are going like crazy. Now, I unfortunately I internalize things a lot, and what is important for managing clients, what used to get me concerned is how the client was feeling. The greatest sin is losing a client for what I was doing, and so you are acutely sensitive to how the client is feeling over time and how they're rating your services, and the way to make sure clients are calm are to set their expectations appropriately. The same thing would apply to a venture capital fund as to an advisory firm, like where I was. You need to set expectations that are reasonable, and if at all possible, benchmark yourself against benchmarks that the client buys into. And so, you have the Cambridge indexes to look at. I would look at a benchmark that the client would agree to at the inception of the relationship. And that, so if I can be close to that or hopefully above it, it relieved a lot of my worry. I didn't worry about the client losing money, because usually there was a good reason for the client to lose money that are exogenous, and I could explain those away. So that didn't bother me. The capital markets are beyond anybody's control.
Got it.
Mm-hmm.
Wills, you think it's time to do the 2-minute drill with Doug?
Yeah, let's do it.
Douglas, are you ready? Is your seatbelt on?
I'm buckled.
Okay, Wills, question 1.
What drove, we asked a species of this, I think, throughout the interview, in a sentence or less, what drove you throughout your career?
What drove me throughout my career was finding a way to eat well and sleep well at the same time. At Cambridge Associates, it was perfect because I was providing a good service to America's greatest treasures, these nonprofit organizations, and I was doing well for myself and really enjoying the work. I'll give you an example. I put the Hewlett Foundation into Benchmark 1, which not quite founded, but was the first major outside investor in eBay. And they made around $1 billion off of that investment. And that allowed the foundation to give another $200 million away every year uh, in grants. When that one decision, if you just think of the leverage of that one decision for a great organization doing great things, you really do sleep well.
Wow. Well, after we're off the podcast, Doug, you're going to have to give Wills and I a few tips. So thinking about a career that, I mean, literally spanned 4 or 5 decades, which of your accomplishments, business accomplishments, are you proudest of and why?
Well, I'm proudest of what we created in California, or the entire West Coast for Cambridge Associates. Basically got the California office off the ground, and when I retired, we had about 75 people in the office, and were contributing a lot to the bottom line of the firm. So we employed a lot of people. We gave them enriching, successful careers. We served clients extremely well and made them more financially successful. And through that, they were able to do better things for the world. And so I think it was a happy marriage between my love of the work and the impact of the work on the environment.
As you think back on all the decisions that you've made, is there one, or it doesn't have to be the hardest, but one of the very hard decisions that you had to make that turned out to be a really good one?
Oh boy. Well, yeah, I had a guy who was referred to me as a new employee. He had spent 14 years as a partner at Solomon, running their West Coast San Francisco office. So great background, but he was pretty well along in his he was all right. He was old, and and I didn't quite know what to do with him, but I hired him, and he turned out to be just an awesome employee and stayed with us for his final 10 years of his working career. And so I kind of took a flyer on him, but my instincts told me that he would be good.
So let's flip the coin. If you could reverse one decision you made over your career, anything come to mind where you just, you know what, I had it wrong?
When I accepted the position of treasurer at Oracle Corporation, it happened to be about a year before Oracle hit a wall and almost went out of business. 70% of all the officers were out the door in 1 year. Blood all over the floor. It was a miserable experience. And after that, I decided I'd go back to a professional environment. And I called Cambridge Associates and I said, look, I had you on my payroll for 5 years. Would you mind returning the favor? And they said, sure. As a matter of fact, we need somebody to man our San Francisco office. So the Oracle decision was a horrible decision, but it led to wonderful things.
Got it. We're going to do something, we're going to call it an advice round robin. And we'll just touch on a piece of advice you would give to various different people, actually representing different categories. Are you ready?
I'm ready.
Piece of advice for an entrepreneur.
Fail early, fail often, and keep at it.
Piece of advice for a fund manager.
Decide if you're really cut out to be a fund manager And if you're not, get out of the business. If you are, love it.
Piece of advice for an LP.
Try to understand the DNA of the fund that you're investing in, and follow what they're doing closely.
And piece of advice for a 25-year-old Doug Carlson.
Decide, try to figure out as soon as you can really what you enjoy doing, and then pursue it relentlessly, even if the dollars aren't there initially.
That's great. Anything, a piece of conventional advice that's out there that you disagree with strongly, where you have kind of a contrarian view?
Well, yeah, and I almost hate to say this because it defies what I did for many years at Cambridge Associates. I think the best way to outside of private equity, which I strongly believe in as a way to add value, for the whole rest of a portfolio, the best way to invest is through passive index funds, and using just a handful of them. And unless you're 70 or 80 years old, have basically nothing in bonds, just all equity index funds, diversified globally. And you can do that with about 3 or 4 of them. So have almost nothing in bonds, all index funds, and don't look at it too closely, so that you ride through the recessions. Keep 2 years of spending in cash on the sidelines, so that you're not forced to sell at fire sale prices.
And as you sit and look back over a long, many splendored career in life, how do you measure personal success?
I measure in terms of career success.
Personal, as a person.
Yeah, I think personal success is achieved mostly through relationships. Those relationships being first and foremost one's family, followed by one's friends, to nurture those relationships and deepen them over time. And secondly, show love to everybody you encounter in day-to-day life, whether it's a checkout person at the supermarket or a nurse at a hospital. Recognize that they're people with the same needs and desires as everybody else. Related to that is try to see through ego. I think most people who posture are basically have fragile egos, and which is why they posture, and not to take it personally.
All amazing points. And the one about showing love is something that just happened like in the last 2 hours, just an experience with a person. I was like, you didn't have to act like that. Like, we're all people here. So that one just hit me right over the head. One last question, if we may, and I think it's related here, and we don't want it to be too kind of like too much of a downer. But what would you like your epitaph to say?
I would say, Doug Carlson, good guy, did wonderful work for society and was beloved, period. That's really what it comes down to. I'm not sure I would have said the same thing 30 years ago when I was hard driving, but I reached a point in life now where I'm putting I'm migrating from success to significance in terms of my emphasis.
Well, Doug, many thanks for your time, your insights. I think they're great points throughout here, really interesting perspective. And based on what I know about your DNA and your family, That epitaph will likely not have to be written for another 40 years.
Well, ditto to you, Andy. I think you've got some good DNA there based on what I'm saying.
Right. Well, Douglas, seriously, truly appreciate this. Thank you very much for listening to our interview with Doug Carlson, who had a 25-year career at Cambridge Associates advising some of the most sophisticated capital allocators in the world. In our interview, Doug touched on the importance of being obsessed with what you work on, staying the course in both bull and bear markets, how success can actually be destabilizing, and migrating from success to significance. This is Andy Greenfield of TIA Ventures. We are a seed stage venture capital fund investing in companies that have achieved visceral product market fit with teams ready for prime time and whose customers cannot live without their products. In our next episode, we will be interviewing Jason Sherman, founder CEO of Taproom, a company that is revolutionizing the beer business.